Banks and asset managers earn billions from sources you never see, and the most shocking one hides in plain sight. Stay tuned as we count down the top 10, and number 1 is something almost nobody guesses. Surprisingly, custodial banks charge hefty fees simply for holding institutional assets, and that's just the tip of the iceberg. Large investors, pension funds, sovereign wealth funds, and hedge funds pay ongoing charges that cover safekeeping, settlement, and reporting. These fees, often calculated as a fraction of a percent of the assets under custody, can add up to billions across a firm's portfolio. The revenue is steady, low risk, and largely invisible to the end client, who sees only the primary investment performance. While the exact figures vary, estimates suggest that top custodians collectively generate upwards of $10 billion annually from this line item alone. And as we move up, the next hidden stream involves turning idle securities into cash without the owner even noticing.
Hidden within the world of securities lending lies a lucrative cash flow that many investors never realize they're funding. Financial service firms lend out securities held in client portfolios to short sellers, earning a fee that can range from a few basis points to over 1% of the loaned value. The borrower pays collateral, often in cash, which the lender can invest, creating an additional income layer. Though the practice is regulated, the exact profitability is opaque, with estimates indicating that major custodians earn several $billion each year from these arrangements. This revenue is especially attractive because it leverages assets already on the balance sheet, requiring minimal additional operational cost. Up next, we'll explore how data, something you think is free, actually becomes a premium product for banks.
Few people know that the massive data troves collected by banks are packaged and sold as high-value analytics services. Institutions aggregate transaction histories, market trends, and client behavior, then offer insights to corporate clients, asset managers, and even government agencies. These services are billed per report or via subscription models, often fetching six-figure contracts. While the precise revenue is guarded, analysts estimate that data-driven offerings contribute upwards of $2 billion annually for the biggest firms. The appeal lies in turning raw numbers into strategic advantage without exposing individual client identities. As we continue upward, the next hidden stream is a behind-the-scenes platform that lets other banks brand its technology as their own.
Hidden in plain sight, many FinTech startups and regional banks rely on white-label platforms built by the industry giants, paying licensing fees that swell the provider's bottom line. These turnkey solutions cover everything from digital onboarding to compliance engines, allowing partners to launch services under their own brand while the underlying technology remains owned by the parent firm. Fees are typically structured as a mix of upfront costs and per-user or transaction royalties, generating recurring revenue that scales with the partner's growth. Estimates suggest that white-label licensing contributes roughly $1.5 billion across the sector each year. The model not only diversifies income but also embeds the provider's infrastructure deeply into the market. Coming up, we'll uncover the small print fees that appear whenever money moves across borders.
Beneath the surface of every international wire lies a modest but steady charge that fuels a hidden profit stream. Banks levy cross-border transaction fees, often a flat amount plus a percentage of the transferred sum, covering currency conversion, compliance, and network usage. While individual fees may seem trivial, the sheer volume of global transfers means the aggregate revenue climbs into the multi-billion-dollar range annually. Some estimates place this income at around $3 billion for the largest providers, with the exact figure fluctuating based on market volatility and regulatory changes. These fees are typically disclosed in fine print, making them easy to overlook. Next, we'll reveal how firms monetize the private equity world through specialized servicing.
Imagine a world where private equity funds outsource the entire life cycle of their investments to a third-party custodian. That's exactly what many major financial service firms do, handling everything from capital calls to dividend distribution, all for a fee that can be a percentage of the assets under administration. Because private equity deals are complex and illiquid, the service commands higher margins than standard custody. Industry reports suggest this niche generates roughly $4 billion each year, though exact numbers vary by firm. The revenue is attractive because it pairs high fees with relatively low operational risk once the infrastructure is in place. Up next, we'll dive into the software side of risk, how firms sell sophisticated tools that protect portfolios while padding their own books.
According to market analysts, risk management platforms have become a gold mine for banks that develop proprietary algorithms and sell them on a subscription basis. These tools help clients monitor market exposure, credit risk, and regulatory compliance in real time. Subscription fees can range from tens of thousands to several $100,000 per year per client, and with hundreds of institutional users, the revenue stream can easily top $1 billion annually. The appeal lies in the recurring nature of the income and the high switching costs once a firm integrates the software into its workflow. While exact figures are proprietary, the consensus is that this line item is a fast-growing contributor to overall earnings. Next, we'll explore the newest frontier, digital asset custody for cryptocurrencies.
Deep beneath the hype of Bitcoin and NFTs, traditional custodians have quietly built ultra-secure vaults for digital assets, charging hefty fees for storage, insurance, and transaction processing. Institutions seeking legitimacy turn to these services, paying anywhere from 0.1% to 1% of the assets under custody each year. As crypto adoption expands, the estimated revenue from digital custody is climbing, with some analysts projecting that the top providers could be pulling in over $800 million annually by 2026. The model leverages the same infrastructure used for physical assets, but adds layers of cybersecurity and regulatory compliance, justifying premium pricing. Up next, we'll see how partnerships with FinTech innovators unlock yet another hidden cash flow.
Unexpectedly, many legacy banks have entered revenue-sharing agreements with fast-moving FinTech startups, allowing the latter to tap into existing banking infrastructure while the former receives a slice of the profits. These arrangements cover services like payment processing, robo-advisory, and peer-to-peer lending platforms. The revenue share can be structured as a percentage of transaction volume or a fixed monthly fee, and collectively, they contribute an estimated $2 billion to the bottom line of the biggest institutions. The benefit for banks is twofold. They capture new market segments without heavy R&D, and they diversify income beyond traditional interest margins. Finally, we arrive at the most impactful and often misunderstood source of profit.
Finally, the crown jewel of hidden income streams lies in the proprietary trading desks that many major financial service providers operate behind the scenes. These desks use the firm's own capital to trade equities, bonds, derivatives, and increasingly, digital assets, aiming to generate returns that are not tied to client fees. While regulatory reforms have curbed some activities, estimates suggest that top-tier desks still produce billions in net profit each year, often accounting for a significant portion of a firm's non-interest income. The earnings are especially attractive because they stem from market-driven gains rather than fee-based services, providing a high-margin boost to earnings reports. This hidden engine illustrates how banks and custodians turn market expertise into a powerful, albeit less visible, revenue source.
What a journey through the secret side of finance. Those hidden streams show how massive institutions turn everyday services into massive profit engines. If you enjoyed uncovering these covert cash flows, subscribe so you never miss the next mind-blowing list we drop each week. Which revenue stream blew your mind the most? Drop your answer in the comments, and if you liked the video, give it a thumbs up. Thanks for watching.